Now onto the bond market moment with Todd Colvin of MarkIV Brokerage. Todd, yesterday the stock market rose as the 10-year bond yield dropped.
10-year note yields have seen a rally since the beginning of July. We've rallied about 20 basis points from 420 all the way up to 440 before backing off yesterday and seeing a close around 435. So after 5 consecutive days of rallies starting in early July and following that stronger than expected employment report, yields saw a bit of a back off. Now, yesterday's key was the FOMC minutes. Didn't really add anything to the puzzle here as we continue to watch. The Fed seems divided over how inflation and tariffs are going to mix. Likewise, when to start cutting. Some leaning towards July or September, and others leaning towards later in the year. But ultimately, market is still pricing in 25 basis point rate cuts. So obviously now we have 2 very well-defined areas in 10-year, 420 and 440. We started there at the early part of the month. We rallied there over the last week or so, and now we backed off. But ultimately, those were your 2 levels. If the Fed is looking for positive data, if things are going well in the market, we're going to see it move higher and get above that 440 level. However, if things start to look a little unfortunate on the economic front, or if we see the need for the Fed to act more aggressively, we'll still test that 420 level. But right now, those are the 2 levels we're watching, and not so much for this week. We had some mediocre auctions earlier in the week. Today we get the 30-year, but next week will be the key. We get inflation data via CPI and PPI. That is what the Fed is really going to hang their hat on, and not so much as to July FOMC, but looking down the road at September, which is still pricing in about 80% odds.